I'm assuming you've analyzed this problem and you've realized we've got one temporary difference, and that's from this installment sale. This $5 million in municipal bonds is a permanent difference because that will never be taxable as the code is currently written. So the temporary difference reverses itself over the following 2 years, and we need to determine how that impacts the balance sheet and the income statement. More specifically, do we have a deferred tax liability or a deferred tax asset? And how large is that? And the challenge here is that we have tax rates that change over the period in which that temporary difference reverses itself. So this idea of coming up with, and I've got the journal entry kind of framed up here, the income tax expense and the income taxes payable, and plugging the difference for the deferred tax asset or the deferred tax liability does not work. So we're going to start here with the pre-tax financial income prior to both of these items, which is the installment sale of the property and the $5 million of the municipal bond interest. And we're going to work our way backwards because what we will be able to calculate without hesitation, I guess, if we know the tax laws, is how much we have to pay the IRS. So the IRS starts at this 145, and they say, well, we're going to take away that $5 million because that will never be taxable unless the tax laws change. So we'll subtract that from the 145, and then we need to determine what to do with the additional $45 million in sales. And the way this $45 million in sales work, if we have installment sales, is, well, you got to read the problem, and the problem tells that the installment sales income is reported in these following 2 years. That means it is recorded for financial accounting purposes. It's in the 145, but for tax purposes we don't record it yet. We'll record it over the following 2 years. So we subtract out as well that $40 million, and what you're left with is $100 million of taxable income. And we know that taxable income is used to calculate income taxes payable. You take that number times the enacted tax rate and the year in which you're paying the tax, which is 2016. So we look back at the problem and we need to figure out what the tax rate is for 2016, and right here we're told it's 40%. So you would take that $100 million and multiply it by 40%, and you'd have a $40 million tax bill. So that right there gives us $40 million. Okay, now we can't come up with the income tax expense yet because we have this temporary difference, this $40 million, which reverses itself evenly over the following 2 years. So what we have to do instead is make this little schedule here that says, okay, in 2017 and in 2018 we have a $10 million and a $30 million reversal, and the tax rate for each of these 2 years for 2017 is 40%, and for 2018 it's 35%. Kind of run out of space here, but the reversal will happen by taking the tax rate in that period times the amount of the reversal. So $4 million and $10.5 million. So $14.5 million is the difference. Now we need to determine whether this is a deferred tax asset or a deferred tax liability. The easiest way I can tell you to determine whether you have a difference that's a deferred tax liability or a deferred tax asset is to look at this little thing I showed you in class, which is this little box trick here. So we need to determine whether the IRS income is larger or the GAAP income is larger in the period in which the temporary difference originally arises. And that happens to be in 2016. So if in 2016 the IRS income, taxable income, is larger than GAAP income, we have a deferred tax asset. But if the IRS income is lower than the GAAP income, we have a deferred tax liability. So let's take a look here. We're told that the installment sales will be reported for tax purposes in a following period. So that means in 2016, when the temporary difference arose, the IRS did not recognize that income, did not recognize that revenue. So that means their income would have been lower in 2016, which is when that temporary difference arose. So we have a deferred tax liability. So I can plug that in here, and I'll just show it in the T account. We have a credit balance of $14.5 million. So that means we're going to credit deferred tax liability. And by default then, we have the income tax expense, which goes on the income statement, is a plug of $54.5 million. So that answers the very first part of the question, which asks you to present the journal entry at the end of 2016.